and welcome to our webinar. We are live. It's the 27th of April, 2023. It's 7:01 Eastern Time. Thank you everyone for joining us. All right, let's go to this slide. My name is Philippe Chalegan. I'm the co-founder of Boost Capital Group. Welcome again to our live webinar, Maximize Your Earnings and Discover the Secrets of Passive Income in Real Estate. We will have a Q&A session at the end of the webinar, so feel free to ask any question you may have in the Q&A by clicking the Q&A icon in your Zoom window. And as the questions, again, we'll cover them at the end of the webinar. We have a disclaimer. Boost Capital Group does not provide tax or legal advice. The material herein is provided for informational purposes only and should not be construed as investment advice or an offer or solicitation to buy or sell securities. So a little bit of an introduction of my partner, Jeff, and I. We have created and Boost Capital Group because we do share a common vision and values. Our vision is that we believe that everyone deserves to spend time with their family while building a bright financial future. And in order to do that, we offer alternative investment opportunities in real estate to busy professionals and family providers. Together, we have more than 10 years of experience, and we've helped people invest in 2,800 units, multifamily units, with an average of 30% annual return on full cycle deals. Exceptionally, today I will be alone presenting. Jeff couldn't make it. He had a last minute obligation. So I will take the opportunity to tell you more about myself. You may have heard in my slight accent that I am originally from France. I came in America over 20 years ago and spent most of my professional career here. My background is in mechanical engineering. I worked for a company manufacturing business jets as well as military aircraft that is based in France and that has a subsidiary here in America. So that's how I came to America initially. I've been doing real estate for quite a while, multifamily for 6 years, and I've been doing full-time multifamily for three years. I am also doing some mentoring and teaching students how to begin in this industry in multifamily. And finally, last year, I started a meetup here in Atlanta, where I reside. A meetup, the group is called Atlanta Commercial Real Estate Network, or ACREN, and we meet every third Tuesday of the month. We're about to announce our next event shortly. So if you are in Atlanta, please reach out and I will or look for ACREN, ACREN in on meetup.com. All right. So today we are going to talk about discover the secrets of passive income in real estate. We have 5 topics that we're going to cover. it's a lot of information. So there will be a recording, so don't worry. But first, understanding the different asset classes, comparative analysis. Second, reasons why real estate investments are popular among busy professionals. The third topic is the top 5 benefits of investing in multifamily real estate. Fourth, passive multifamily investment advantages. And finally, multifamily syndication, what it is and how it works. So let's start. So understanding asset classes, when it comes to investing, you want to understand the nuances of the different asset classes that you're going to invest in, and to make informed decisions that align with your goals and your risk tolerance, right? And for instance, goals are supplement your income, prepare your retirement, or build generational wealth for your family. So the typical of the asset classes available are cash, equities, fixed income, and alternative investments. In the cash category, the first category on the left, you have savings, for instance, treasuries, as well as certificates of deposits or CDs. In equities, you have stocks, as an example, fixed income, bonds, alternative investments. You have real estate, obviously, is one, and it could be either a direct ownership, such as owning a single family or a share of a multifamily, or it's indirect ownership via REIT, which stands for Real Estate Investment Trust. Also in that category of alternative investments would be, or is included, precious metals and cryptocurrency. So here is a little chart that we prepared, and it's a chart that is showing the risk and reward of popular investments based on the last 10 years of data. I've just updated that chart last week. So and to illustrate reward, we're showing the average yearly return on the vertical axis, and we show volatility on the horizontal axis, and volatility is a measure of consistency of returns. Meaning, for example, inconsistent returns, sometimes positive and sometimes negative, mean high volatility. That means high risk, because what if you need your funds when you're in a downturn, right? When sometimes it goes up, sometimes it goes down, and if you need your principal when it's down, it's not a great position to be in. So you're going to want low volatility, so less risk, meaning you're going to want an investment that is more on the left side of the chart, and high returns. So it happens, we split that chart in 4 equal areas, and right now you have multifamilies in that area, and a very close second is going to be the single family rentals. So what we can observe, now that I explained the chart, is that over the past 10 years, inflation has averaged 2.57%, right? And we know currently it's much, much higher, but we're looking at long term. And from that standpoint, if you look at the average returns of treasuries, CDs, and savings, those investments that didn't even catch up with inflation. You're behind when you are investing in those type of investments. The second thing that we can observe is that brokerage accounts, i.e. stocks, and the REITs that I mentioned earlier, the real estate investment trusts, they have produced inconsistent returns, so they have high volatility. So again, going back, my third statement here is we feel that from a real estate standpoint, and the examples we've picked is multifamily properties as well as single family rentals. They offer a good compromise between high returns and low volatility. Again, if you have any question, I know it's a lot of information. Any question, feel free to ask them in the Q&A box, and we'll cover your questions at the end. So, some questions we wanted to share with you, it's like we're inviting you to ask yourselves these questions. It's like, has the stock market volatility negatively impacted your investment portfolio, right? Because for several years, stocks went up, and then until they didn't, and that happens on a regular basis. So are you impacted by the recent crisis? Also, are you hedging against inflation? As we saw, if there are some investments that are not even keeping up with the inflation. Sorry. So next thing we wanted to share with you is, if you're not familiar, there's a survey is made every 3 years. It's called the Survey of Consumer Finances. And this survey is made to understand financial behavior of US families. The last survey, which took place in 2019, is showing that the families the most likely, the wealthier families are the most likely to have real estate part of their portfolio. So all the families that have been surveyed, they've been split in different tranches of percentiles. And if you look at the 90 to 100 percentile, meaning the top 10% of wealthiest family, you would have at 45% of this group of the wealthiest families, they have real estate in their portfolio. So you can see a trend going from the less wealthiest, they don't have real estate, and the more wealthiest families they are, and more of them have real estate as part of their portfolio. So, we're asking you, is real estate part of your investment portfolio? We strongly believe, as that we believe so. All right, let's go to number 2. As mentioned, I will answer all the questions at the end. So please be patient, but don't hesitate to ask questions. Thank you for people who are asking questions. So second topic tonight, reasons why real estate investments are popular among busy professionals. So we have 5 reasons here. First is cash flow. Cash flow being income minus expenses, and including paying off the debt, and a stabilized asset will generate cash flow, and that's cash flow that is going to be distributed to investors. So the second reason is going to be equity, because when the debt is paid, and usually real estate is purchased with a loan, with some debt, that will include payment of principal, and in other words, the rent being paid by your tenant is going to increase your ownership, increase your equity in the property. Next, we have depreciation, and that's a tax advantage. So a single family property, a single family rental, it can be depreciated over 27 and a half years for the building part, not the land. The building can be depreciated and it can be written off from your taxes. I mentioned or touched on leverage earlier. You can buy a property using a loan, right? As you know, maybe many of you, if not all, have purchased their primary residence with a loan, and you can do the same if you're buying an investment property. So if you think about that as an investment, when you put 20% down, you're going to have that money down work 5 times harder in the big picture, right? So, and that's something, I don't want, I could spend a lot of time on every of these topics, but for the sake of time, I just want to move on. So don't hesitate to ask questions. Finally, in this second topic, we are talking about appreciation. And one thing we want to bring to your attention is the difference, one of the differences between single family and multifamily. So single family, the number one parameter to define value of single family is going to be comps or comparable properties in the same neighborhood, right? So even if you're starting to make, obviously renovations, they can have an effect, or additions, but if you're kind of a one-off, that is much bigger than the neighbors, it's going to hard to put a dollar price, right? In multifamily, in commercial real estate in general, there's a formula that we're going to cover shortly, but the market will have a capitalization rate, and the capitalization rate is the net operating income divided by the purchase price. Again, we're going to touch on that a little bit later on, but just to bring to your attention is that the value is not the same for single family compared to multifamily or commercial real estate. So, again, some questions that you may ask yourselves: how has the real estate market evolved to better accommodate the needs of busy professionals? Right? It's going to be, and actually, I'm thinking about the second question already. But should you invest in single family rentals? Right? And those are good questions, and that's why we want to bring it to your attention, the benefits of investing in multifamily. So again, several benefits. Number one is going to be the economy of scale, right? Because it's going to allow for a lower cost of, for instance, property management, the repair materials, service contracts. The more units you have, if you're going to write a contract on any of those topics, ordering materials or services or property management, if you have 50 units in your building, it's going to cost much less than if you go and shop for, a small portfolio of single family, right? Second, tax benefits. We touched on depreciation of single family earlier. When you look at multifamily asset, you can accelerate the depreciation. So the tax write-off can be accelerated. And that's done through a segregation analysis study done by professionals. And then you can accelerate the depreciation of some of the parts of the building. And finally, a quick note to mention the bonus depreciation. Last year was the final year of that you could actually depreciate 100% of the asset year one. Now it's phasing out this rule, but again, don't understand all these tax benefits. Please discuss them with your CPA. As a very simple rule of thumb, if you have a job and you're making active income, some of these benefits, they will have a lesser impact. So just something to bear in mind for you. So my favorite topic, the forced appreciation. So again, I mentioned the cap rate earlier. If you switch cap rate, is NOI, net operating income, minus or divided by value of property, and you can switch those two things around. And in other words, value of the property is NOI divided by cap rate. The NOI is going to be the income minus expenses, right? And how can you increase the NOI? Well, in commercial real estate, there is something that is called forced appreciation, because if you do things to increase your NOI, automatically you're going to increase the value of the property, right? And I just put some examples, and I'm not going to read everything again for the sake of time, but a very simple way to increase income, and typically that's what we will look for, is to bring rents to comparable rents in the market, right? Because maybe just it was mismanaged, the property, and you can bring rents a little higher. Another thing is through renovations. Maybe if you spend $5,000 on a unit, you can raise the rent of $200, and you're going to make good returns. The other side of things is decrease expenses, right? And maybe it was a mom and pop owned property, and it's something, if you bring professional management, then you can lower the expenses, right? And there are other things, the water consumption reduction plan, and other tax incentives, etc. I have a whole list in what I teach to my students. Next, we have risk reduction and workload. So from a risk standpoint, the smaller your portfolio, the higher the effect is going to be of vacancy. So, right, if you own two houses and you have one that is not occupied and you're taking a little, a couple of months to find a tenant, well, you had 50% occupancy in your portfolio, and that's not great, right? Like a good healthy number is 90%, but small portfolio is much harder. In the same manner, if your tenant is a bad tenant and is leaving your property, not well taken care of, sometimes the deposit is not enough to cover the repairs. And that happened to me. So both, all cases. So that's why I moved to multifamily. So multifamily, obviously, now you have many more units, and the effect of vacancy or bad tenant is much less impactful. So next topic is the workload. The workload, each time you're going to acquire and add a property to your portfolio, you're talking about finding a property, underwriting, negotiating, securing capital, closing, and then managing, right? So for each property that you add, you have all these steps, and at some point it's adding up. And if you think at multifamily, obviously it's going to be a little bit more complex to perform this task, like the closing and the lender and the requirements going to be a little bit more complex, but you can acquire many doors with one transaction. So workload overall, the average workload will be lower, workload per door. So now, again, because we like to help busy professionals and family providers, the question you can ask yourself is like, how much time can you dedicate to finding funding, managing these investments, right? And also, do you have the industry knowledge to buy larger properties? So we have a solution for you. This solution is a passive investment, which means that, obviously you don't have an active involvement in any facet of the acquisition or the operations. So what are the advantages? Well, it's true passive income in that case, right? You as an investor, you're going to receive a share of the cash flow, and on regular basis going to be distributed to you, and then you will receive a share of the proceeds of a refinance or a sale of the property. The next topic here is that you'll have access to larger investments, again, because you're doing that passively, and you'll have also diversification. So large investments, we want to introduce the concept here of syndication. We'll talk about it a little bit later, but syndication allows to aggregate capital among other investors, and you'll be able, by doing that, to invest in higher value assets, right? And just 90% of multifamily purchases is going to be done through a syndication. So from a diversification standpoint, the syndication allows investors to participate in larger deals, again, larger properties, but it could be for $50,000, for instance, as a, kind of give you an idea of how much it costs. And then, you can imagine to grow a portfolio and invest in different properties nationwide, so you can diversify your investments and have less exposures for all the good reasons that we mentioned earlier. Other advantages, you're going to benefit of the experience of the sponsor. The sponsor, such as us, we're bringing a track record, we're bringing industry knowledge, we're bringing a network of third party, lawyers and contractors and brokers, you name it. We have, it's really a team effort to put those deals together. Next, we have the protection, because for each deal, we're going to create a limited liability company. And from that standpoint, you're going to provide all the members, the investors, as well as the sponsors, a legal protection against lawsuits. In case of a tenant is slipping on a frozen step or something, and as well as protection of personal against any personal financial liability. Number 5, multifamily syndications. We touched briefly on that. We want to spend a little more time explaining what it is, right? And again, it's syndication. It's a real estate structure in which several investors combine their funds to buy a property. So here we put, I think a pretty good overview of what a syndication structure is. It's very simply we would create an LLC, limited liability company, that is going to own title of the property, and it offers legal protection, as we mentioned, and it's going to be governed by an operating agreement. The operating agreement will describe the roles and responsibilities of the general partners as well as the limited partners. In a nutshell, the general partners, and I use this terminology interchangeably with a sponsor, but general partners, they manage the LLC, they actively operate the asset and execute the business plan, they provide the expertise, they're going to contribute some capital as well, it's a lender requirement, and in exchange of the effort, they will receive equity and some fees as well. On the side of the limited partners, so the limited partners are the passive investors. They contribute capital to the deal. They receive equity into the deal. They have a share in the LLC, and they will receive distributions and also tax benefits. And when I say distributions, they will also I should have added receive share into any refinance and disposition or sale of the asset. So how does the syndication, how is it formed, right? So the general partner or sponsor, they're going to find a property, analyze it, structure the investment, obtain financing, coordinate all the acquisition, and then run the day-to-day operations. And also, yeah, as I mentioned before, like you have a bunch of third parties to coordinate as well. So for the acquisition, the sponsor is going to raise capital from qualified investors, typically under Rule 506 of Regulation D, exemptions 506B or 506C. It's SEC jargon, but it's things that we need to share with investors, and you'll hear about that all the time. So meanwhile, you have an SEC lawyer, so Securities and Exchange Commission lawyer, that will prepare a document that is called a private placement memorandum, or PPM in short. This document is describing the investment parameters and business plan, and it is provided to the investors. The investors, they're going to review the PPM, sign a subscription agreement, and also sign the operating agreement of the LLC. And obviously, part of the investment, the investor will send funds in the account for closing the acquisition. So if you wanted to learn more, I will give me 1 second. Yeah, actually, I will copy this link. But we have a blog post. I will make that available later on. Unless I had it. I apologize for the inconvenience. I found it, and I'm going to paste it in the chat. All right. So if you're interested to learn more. All right. And that's all, in conclusion, passive income through real estate can be an excellent way to maximize earnings, right? And you can multiply the streams of passive income by investing in different real estate assets, and that will provide for you an additional level of financial stability and security, right? So we just want to also add that when you look to implement these diversification strategies in your portfolio, you have to perform your due diligence, do your research, seek guidance, ask questions, and you have what you'll be able to do what you love, and you'll be able to preserve and grow your wealth, right? So we want to conclude the presentation part of this talk by a quote from Warren Buffett. You want never depend on a single income, and when you make an investment, it's going to be to create a second source of income. I think it's very wise. Very wise. So before we start the Q&A, we just want to mention our current investment opportunities. We have two of them. The first one is our portfolio one. It's a portfolio of 3 properties representing 654 units. They are located in Tucson, Arizona, Houston, Texas, and Phoenix, Arizona. Among these 3 properties, they have 3 different business plans that are called Core, Core Plus, and Value Add. Core meaning it's a very recent property and it's mostly a cash flowing property. And on the other end of the spectrum, between the 3, you have value add, where you can do a lot of renovations and and add value, as I described earlier, the forced appreciation strategy. And Core Plus is just in between. The returns for this investment is a 1.86x in 5 years, meaning that if you put $1, you will have in return $1.86. There's a preferred return of 8%, an internal rate of return of 14.3%, and annual average return of 17.2%, and it's currently cash flowing. I forgot to mention the specific disclaimer here. Performance estimates are not a guarantee of future results, and this offering is made through the SEC Regulation D 506C. And as I said earlier, that's something that you'll hear about a lot. These numbers, 506B, 506C, and it's for accredited investors only. So please refer to our private placement memorandum that we mentioned also earlier, and a partnership agreement for more details on risks. Finally, our second opportunity available, it's called short-term debt one, and it's about short-term debt loans in Austin, Texas, mostly, and you can see on the little map there, it's around Austin, but it provides high cash flow, and it's secured by real estate assets. It's a little bit different compared to the typical multifamily syndication, but we found that investment interesting as well. And the purpose of these loans that are made to other entrepreneurs is going to be real estate renovations and development, and mostly in single family area. There is a cash on cash return of 10%, and distributions made quarterly. Also, same disclaimer, performances estimates are not a guarantee of future results. This offering is made through the SEC Regulation D 506C for accredited investors only. Refer to private placement memorandum and limited partnership agreement and subscription agreement for details on risk. So that concludes our presentation. We are entering our Q&A session. Thank you again for people who have posted questions. Feel free to ask more. So I will take, I see, okay, we have 8 questions. So how is inflation affecting the passive multifamily investor over the past 5 years and into the next 5? From Larry. Larry, if I had an answer to that, the next 5 years, I think it's going to be a number of parameters that you're going to want to consider. So over the past 5 years, the impact certainly was the prices of materials, because of the inflation. Number 2, it was the manpower of particularly maintenance staff. It was really hard and still is pretty hard to find qualified people. And an indirect effect of the inflation is that the Fed increased their interest rates, and in turn all the lending has been interest rates have been much higher, and that has put a lot of pressure on prices. So there are some situations where it's right now it's not necessarily like the best time to sell. So if you can wait a little bit, you'll get a better price later. But so that would be the most impactful thing. So into the next 5 years, I think there's a lot of anticipation that we'll come back eventually to normal. It might take another few years, the inflation and so on, or at least for the Fed rate to come a little lower. So it's going to stabilize. It's going to stabilize. But I would say, how is it affecting my decisions now? I want to be much more careful about having control of what's my interest rate, what's my cost to exit a deal. If there's a prepayment penalty, I want to have like all these numbers that are predefined in advance, because in both cases, your interest rate can be variable and your exit can be linked to the treasuries, for instance. So hopefully that answered your question. Second question from Larry. How could a market recession affect the average passive? So the recession, that's a good question. That's a very good question. If there is a recession, but we've heard about soft landing. We'll see, it's possible. But if there is a recession, what will happen, like the most number one first effect, there will be layoffs, and then meaning that you'll have tenants who cannot pay their rent. So I would say when you look for an investment, you want to look at a stress test analysis, and particularly, what if the economic occupancy of the property is going to get lower? What's the effect? Can you still pay the mortgage or not? And up to what level you can pay the mortgage. That's going to be the bottom line there. So that's the if the deal was properly stress tested ahead of time and it's ready, there's sufficient margin, either again, the stress test, so the meaning that you can afford enough, you didn't leverage too high, and even if you have 80% occupancy, you can pay the rent, you'll be fine. The other way you can take care of that is have higher reserves. It's another way to take care of that. So I would say that's, I would be pretty careful about gauging those parameters when you enter a deal. Atiba is asking, how do you find your properties? So typically, we are, it's through broker relationships. We're working. We have with like major brokers in the market, real estate brokers, and they're going to be the best person, who can introduce serious sellers to serious buyers, because we tried wholesalers. That approach is fine with single family. In multifamily, it's not as reliable. Again, it's a whole discussion that we can have about that topic. Which industry did you target when you first started? I'm not sure I understand the question, Atiba. Another question from you. Should I invest my own money or finance? Well, I guess it depends what you want to do, right? Because so if you're buying a single family, what we're saying, what you can certainly finance. But otherwise, if you're doing a passive investment, then we would advise or recommend to invest your own money. You don't want to leverage money that you're investing in such passive investment. That makes sense. How does accelerated depreciation benefit the passive investor? An investor has to wait until the building is sold. Another question from Larry. And only against passive income. I will speak to my CPA. Yes. Okay. Yeah, definitely talk to your CPA. So accelerated depreciation, it's going to allow you to write off part of your investment. So if you're going to invest 100,000, for instance, you may be able to write off the same amount up to, which would be 100% depreciation, but typically would be a little between 60 and 80%. But again, so now the thing is, if it's active income, that's not, you won't be able to write off everything. So you really have to work with your CPA to do a simulation for that. You can only do the whole write-off against passive income, but don't, so I guess the short answer is it will help people who have passive income. But I would say, if you cannot, as an active income earner, if you cannot benefit of the write-off, it's going to stay on hold until you can benefit of it. So that's and I would say over the 5 years, you'll be able to write off quite a bit. But again, so this tax benefit, you have to realize there is a depreciation recapture at the end. So it's a temporary you're going to pay less taxes temporarily, and then really when you come back to a disposition, you're going to want to reinvest the money to stay in that mode of being able to depreciate as much as you can. What are the best methods to evaluate the experience and trustworthiness of the syndicator? Well, I think it's number one, is you certainly want to have a conversation with them, with like all the partners. See if you're comfortable with them. You can check their track record. You can talk to some of their investors, talk to some of their other partners, see if, what they stand for is what, at least, or at least what they're broadcasting is in tune with what you hear, the feedback you hear from other investors and other partners. I would say that's I think all these relationships is something that are built in time, and people have to learn to it's like a know, like, and trust relationship. So, but yeah, talk to them and talk to their investors and partners. What was my worst investment? Well, I think it's so far we had some investment that didn't work as expected. But I'm knocking woods, but we didn't lose money. But so, and that's what is interesting with real estate, because it's going to be secured by a real asset. So you're going always to have the asset to back your investment. It's not like many years back Enron that went to, their stock went to zero. So obviously, you will always have something to back up. But yeah, my worst investment to date was actually my first, because we ended up we had to sell, and we had to sell like during the pandemic, and because we kind of underestimated the reserves on that property, and we didn't make. I think we made over 3 years we made less than 10%, but it was we preserved our capital. Anonymous attendee, which markets are we targeting and why? We are targeting, actually we have a whole, if you want to set up a call later on, we can show you our criteria, but we have a whole set of criteria that we have defined pertaining to markets, deal size, other partners that we're working with. So particularly markets, we're looking at 500,000 or plus people in the metropolitan statistical area, or MSA. We are looking for population that is growing. And we are also looking for multiple employers in multiple industries, and low crime. Those are like the headlines: low crime in the submarket. Why? I think the key takeaway there is that population growth. If there's population growth, there is going to be growth in demand, which means that the rents are going to be higher. So that's the, in a nutshell, markets where there is growth. We are monitoring. If you watch our prior webinars, there is a short, a lack of supply of apartments overall nationwide, but if you look at the markets that are growing fast in population, those are where the best opportunities are. Yeah, there is 7% rates available in T-bills. Well, yeah, it's right now. It's right now. Yeah, is it how do you compare like currently the current investment to real estate? Well, it's again, you have tax benefits that are available. Maybe higher returns. it's yeah, you have to weigh your options there. You're welcome, Larry. And are we looking in Nashville? No, not currently. We're looking a lot in Atlanta, where I reside, and also Georgia as a whole, and also South Carolina and North Carolina, which are the two states between my partner Jeff and I. So we are getting. It is unbelievable. I cannot. It's almost 8 p.m. So we will keep it at the hour. If you have any additional question, again, thank you so much for joining us. If you have any additional question, you can email me at philippe@boostmycapital.com, or also info, which is going to reach both of us, but at boostmycapital.com. If you scan the QR code, you'll have access to a different options to contact us. So feel free to use that. You can also follow us on Facebook, LinkedIn, and YouTube. So this call was recorded. We will send the replay within the next few days. We have a team who is taking care of that. And it will be posted on YouTube. Again, thank you everybody to spend the hour with us. Hopefully it was useful, and we're looking forward to talking to you soon, and otherwise to have you as guests to our next webinar next month. Thank you again, and bye-bye.